honestly touches almost every organization, big or small, preventing cash larceny. Now, our insights are drawn from a very thorough, expert source. It's a fraud examination checklist specifically designed to lock down cash assets. And just so you know exactly where this excellent material comes from, please note that this script was prepared by yazan.abogosh, a certified fraud examiner, in collaboration with Easy Pithuni. The original template is provided by the Association of Certified Fraud Examiners and has been reviewed by us. So you know this is grounded in serious, real-world expertise. Our mission today is really to understand, well, where are the weak spots? Where does cash theft actually happen? And maybe more importantly, what are the practical strategies, sometimes quite clever ones, that companies use to stop it? Okay, let's get into this.
Yeah, and it's so important we do, because understanding these mechanisms, it's not just for accountants or fraud investigators, it really gives anyone insight into how financial systems try to maintain integrity. Cash is just so, well, liquid. Securing it is this constant challenge.
Right, it's tempting. So let's define our terms first. The source material breaks cash larceny down into three main buckets. First, there's the obvious one, stealing cash right there at the point of sale from the till. Second, it talks about stealing cash after it's already been recorded in the sales or receivables journals.
Okay.
And the third type is specifically stealing cash from bank deposits, again, after those deposits have been put together.
And that after it's recorded part is key, isn't it? That's the crucial distinction here.
How so?
Well, unlike some frauds where money just disappears before it ever hits the books, larceny means the cash was officially recognized. It was company money on the records, and then it vanished.
Ah, okay. So it implies a breakdown in controls that were already supposed to be there.
Exactly. It often means someone had to actively circumvent or breach a specific control, not just exploit a gap where nothing was recorded yet.
That definitely shapes the prevention side. So let's talk about that first area, the point of sale, the cash register. That seems like ground zero. The checklist really hammers home the basics, like reconciliation.
Yeah, just making sure the cash register tape totals actually match the money in the drawer seems simple.
But it's more than just doing it, right? The source stresses independence.
Absolutely. It points out that the count sheets, the reconciliation itself, should be prepared by an independent employee, someone who wasn't actually working that register.
Okay, so you separate the person handling the cash from the person checking the cash right at the source.
That's the idea. It's a fundamental control right at that point of vulnerability.
Makes sense. And then the checklist goes into access and supervision, like who can actually get into the register. Are access codes really kept secret?
And is there adequate supervision? Either a manager physically present or maybe recordings? CCTV is mentioned specifically, monitoring those register areas.
So creating an environment where it's just harder, riskier to try something.
Precisely. Reduce the opportunity.
Okay, here's something from the checklist I thought was really smart, almost sideways thinking. Using the customer as part of the control.
Oh, yeah. How does that work?
Well, it suggests that if a customer complains about being shortchanged or something not posted right, that complaint should not be handled by the cashier involved. It goes to someone else.
Ah, that's clever. An independent review triggered by the customer.
Exactly. And even more direct, it talks about encouraging customers to always ask for and check their receipts. Maybe even offer a small discount if a cashier doesn't offer one.
So you're basically deputizing the public, in a way. They become an unwitting part of the audit trail.
Right. It makes you think about where else external checks happen.
It definitely raises that question, how much do we lean on technology versus these human or even customer-driven controls?
Yeah.
The checklist seems to suggest it's got to be a mix.
Yeah, a blend. And speaking of tech, the checklist really digs into point-of-sale systems, the POS systems. It asks first, does the company even use one? Because they give such good, timely sales info.
Huge benefit there.
Then it gets specific. Does the POS track inventory perpetually? Does it log all the exceptions? Voids, refunds, no sale transactions, overages, shortages.
All those little anomalies that could hide something.
Exactly. But crucially, it asks, are those exception reports actually reviewed regularly by management? Because the data is useless if no one looks at it.
That's a critical follow-up. The review is where you spot the patterns, right?
Yeah.
Like if one specific cashier has way more voids than anyone else, that needs a closer look.
Which leads to another point they make. Only managers should be able to actually make changes in the POS system.
Right. That stops a frontline employee from easily covering their tracks digitally. If you want to alter the record, you need higher authority, which means more eyes on it, more risk.
It's all about layers of accountability. And it's not just digital. The physical setup matters too. Like, are the registers positioned so supervisors can easily see them? Simple, but effective.
Yeah, line of sight. And securing personal belongings coats, bags away from the register area, reduces the chance to physically conceal cash.
Little things that add up. The checklist also mentions register security features, access controls, needing a manager's key for voids or return.
And using separate cash drawers for each cashier. That's a big one.
Why is that so important?
Well, if there's a shortage at the end of the shift and multiple people use the same drawer, it's hard to pinpoint responsibility. Separate drawers make accountability much clearer.
Makes sense. Isolates the issue. They even mention locking the compartment where the register tape is kept, with only management having the key.
Yeah, preserving that physical paper trail. And keeping copies of customer receipts and void slips for all voided transactions. Again, it's about having the documentation for review later.
So even with fancy POS systems, these physical controls are still vital.
Absolutely. And they tie it back to digital too, assigning unique login codes for everyone, even for physical security systems. It's all about individual accountability.
It really is a defense in-depth approach. Okay, let's pull back a bit from the register itself and look at the bigger picture, the broader systemic controls within the organization. These are things that prevent larceny not just at the till, but further down the line.
Right, and this is where we hit what the source calls the absolute primary way to prevent cash larceny.
Which is?
Segregation of duties. It's the cornerstone.
Meaning keeping different financial tasks separate.
Exactly. Making sure that no single person handles, say, receiving cash, counting cash, making the bank deposit, doing the reconciliation, posting to the accounts, and handling disbursements. You have to split those functions up.
So checks and balances built right into the workflow.
Precisely. The checklist gives examples, like having an independent list of cash receipts made before they even go to the cashier or the bookkeeper.
Okay.
Or having someone totally separate from cash receipts compare the accounting entries to the actual bank deposit slips and bank statements.
Another independent check.
And here's a strong one. Making sure the person who makes the daily bank deposit is not the cashier or the accounts receivable clerk.
It really is all about breaking that chain of control for any single individual.
That's the core principle. And tied into that, there are two systemic controls the checklist mentions that are quite, well, clever for disrupting ongoing schemes.
Oh, what are those?
Mandatory job rotation and mandatory vacations for employees in those sensitive cash handling and accounting roles.
That is interesting. Why is that so effective?
Because many internal fraud schemes aren't one-offs. They require ongoing effort to conceal them. If you force someone to rotate jobs or take a vacation, they lose control of the concealment.
And the person stepping in might spot something unusual.
Exactly. It breaks the continuity the fraudster relies on to hide their tracks. It introduces a discovery mechanism just by having fresh eyes look at the process. It disrupts that concealment element.
That makes perfect sense. It's not just stopping the act, but uncovering the history.
Yeah.
What else falls under these broader controls?
Well, proactive monitoring is huge. Things like conducting surprise cash counts.
Keeps people on their toes, prevents them from tidying up records beforehand.
Right. And regularly reviewing and analyzing journal entries to cash accounts. Just basic oversight.
The checklist also mentions restricting access, doesn't it? To the accounts receivable subledger, the detailed customer accounts, and the main general ledger. Only authorized people should get in, and there needs to be an audit trail of who did what.
And verifying that receivable transactions are legitimate, have proper backup documentation.
What about things like pre-numbered forms? Receipts, return slips.
Yep. Investigating any gaps in the sequence of those pre-numbered forms is crucial. A missing form could mean a hidden transaction.
And sending out monthly customer statements. How does that help?
It's another external check. If a customer's statement doesn't match their records, they'll likely complain, potentially flagging a problem like payments being diverted.
Okay, so lots of systemic checks. And data analysis comes in again, too.
Definitely. Monitoring for things like too many non-sale transactions, or checking login and logout times for registers. Is someone accessing them after hours? Using data to find those outliers.
So we have all these prevention layers, but things can still slip through. How do you then spot the warning signs, the red flags, that something might still be wrong?
This is where detection comes in. The checklist mentions something fascinating. Training managers to spot specific markers that fraudsters sometimes use.
Markers? Like what?
The example given is pretty vivid. An employee keeping, say, a nickel near the register as a mental note to remind themselves they've taken maybe $500.
Wow. That's specific. It really highlights the human psychology involved, doesn't it?
It really does. It shows that sometimes the clues aren't just in the numbers, but in small, seemingly odd behaviors. It underscores why human observation and manager training are still so important, even with all the tech.
Absolutely. And beyond observation, data analysis plays a big role in detection too, right? Looking for patterns.
For sure. Performing trend analysis, looking at sales discounts, coupons, even overrings broken down by each cashier. Does one person consistently stand out?
That makes sense. Looking for statistical anomalies.
Exactly. And identifying suspicious patterns in refunds or voids. Are there lots of transactions just below the amount that requires manager approval? Or transactions for exact round numbers, which can sometimes indicate made-up figures?
What about manager approvals themselves?
Big red flag. Transactions supposedly approved by a manager on a day they weren't even working. That requires investigation. Or seeing multiple refunds for the exact same item, or multiple voids of the same original sale. These patterns scream potential fraud.
So the data can tell a story if you know how to read it.
Definitely. And there's one more detection method mentioned. Using an external perspective.
You mean like auditors?
Well, yes, but also something more specific to the front line. A secret shopper service.
Ah, like the ones that check customer service.
Yes, but in this context, they're also checking if procedures are being followed correctly, testing the integrity of the sales staff regarding cash handling. It's an unbiased, real-world check on whether the controls are actually working day to day.
That adds another interesting layer. Wow, we've covered a lot here.
It's a really comprehensive picture, isn't it? From the till itself, to the system-wide rules, to actively hunting for those red flags.
It really drives home that preventing cash larceny isn't just one thing. It's this whole web of interconnected controls, procedures, and vigilance. A continuous effort, really.
That's the perfect way to put it. And the core themes that keep coming up are independence, having separate people check things, constant vigilance, and systematic review. These aren't just buzzwords. They're the practical foundation for protecting assets.
And understanding this, as you said, isn't just for the finance pros.
Not at all. Anyone running a business, managing a team, even just working in an environment where cash is handled, can benefit from understanding how these controls work, why they matter. Large or small, these principles apply.
So for everyone listening, think about it. Whether it's your own business, your workplace, or even just how you handle your personal finances, consider how these small, maybe seemingly minor controls like separating duties or just asking for a receipt, how they all layer together to create a surprisingly strong defense.
It's that layering effect that's key.
Yeah. It makes you wonder, what other areas of life, maybe completely outside of finance, could benefit from that same kind of detailed preventative thinking, that kind of layered security approach? Something to think about.
Well, thank you for joining us on this deep dive into cash larceny prevention. Keep exploring, keep learning. We'll catch you next time.